Welcome to this explainer. Today, we are unpacking a massive paradigm shift that is literally rewriting how money works across the entire globe. We're talking about the rapid global evolution of central bank digital currencies. Here is today's briefing. We're covering 1. The digital money paradigm. 2. Retail versus wholesale CBDCs. 3. Blockchain and technical hurdles. 4. The 2026 global landscape. 5. Emergency subsidies. And finally, 6. The risks to commercial banking. All right, let's jump right in. Section 1. The digital money paradigm. To really grasp this whole transformation, we've got to lock down what a central bank digital currency, or CBDC, actually is, and honestly, what it isn't. So here's the absolute crucial point. Unlike decentralized crypto like Bitcoin or a private stablecoin, a CBDC is base money. It sits squarely on a nation's central bank balance sheet. It is not run by some algorithm or a tech startup. It's a direct, state-issued liability. If you don't have a finance background, here's the easiest way to picture it. Think of your normal bank deposits as an IOU from a private commercial bank, which, carries a tiny bit of risk if that bank were to fail. Well, a CBDC is the digital equivalent of you holding a physical $100 bill straight from the government. There are no middlemen and absolutely zero counterparty risk for your money. Moving to Section 2, Retail versus Wholesale CBDCs. As central banks build out these systems, they're creating two very distinct lanes based on who is actually going to use the currency. It's really a tale of two systems. Emerging markets are pushing hard for retail CBDCs. These are for you and me, built for everyday consumers to replace physical cash using mobile apps, which is a game changer for financial inclusion. On the flip side, advanced economies are pouring their energy into wholesale infrastructure. A wholesale CBDC is an exclusive VIP network used strictly by financial institutions and the central bank to settle massive, complex interbank trades instantly. Section 3. Blockchain and technical hurdles. So how do we guarantee the security and integrity of a digitized sovereign currency? Now, not every CBDC runs on a blockchain, but many are relying heavily on distributed ledger technology. Think of it like a giant, unalterable record book. You get wild transparency where network participants can view the ledger, incredible security where complex cryptography verifies exactly who is involved, and immutability, meaning once a transaction is locked in, there's no going back to change it. It's a massive tool for stopping fraud dead in its tracks. But that brings us to a huge, glaring vulnerability. Think about it. What happens if a natural disaster hits and the power grid fails, or you just lose cell service? Physical cash always works, right? A digital alternative absolutely has to match that reliability. To get around this, countries are having to get pretty creative. Take India, for example. They are testing offline payment allowances up to 2,000 rupees a day totally without the internet. But offline access requires ironclad security. That's exactly why central banks are heavily integrating digital identity, literally linking a citizen's secure ID directly to their specific smartphone to make sure no one else can exploit it. Section 4, the 2026 global landscape. Let's zoom out and see how this is actually playing out around the world right now, with over 135 jurisdictions in the mix. The global landscape is completely fragmented. You've got fully live rollouts today like the Sand Dollar in the Bahamas and the e-Naira in Nigeria. Then you have these massive, sprawling pilot programs testing the waters in India, Japan, and China with the ECNY. And finally, you've got advanced economies taking a much more cautious research approach. Britain looking at a digital pound, Europe studying a digital euro, South Africa weighing options, and the US actively debating the pros and cons of a retail digital dollar. If we drill down into specific strategies, Hong Kong's three-rail approach is fascinating. It's essentially a masterclass in how to safely transition an economy. Rail 1, lay the tech and legal foundations. Rail 2, dive deep into industry pilots. And Rail 3, consolidate all that data to set a strict implementation timeline. No rushing, just a highly structured blueprint. Section 5, Emergency Subsidies and Financial Inclusion. Beyond just upgrading our banking plumbing, CBDCs give governments completely new ways to interact with us. Consider this staggering number, 1.7 billion. That's roughly how many unbanked people there are globally. By ditching this strict requirement to jump through hoops and get a traditional commercial bank account, a digital fiat currency can seamlessly bring massive populations into the digital economy. Literally, all a citizen needs is a smartphone.
Plus, this sets the stage for instantaneous government-to-person transactions. Imagine a crisis hits, and the government decides to issue a digital dollar stimulus. Instead of waiting weeks for a check in the mail, those emergency subsidies hit your digital wallet in seconds. Even wilder, it can be programmable money. That means the funds can be coded so they can only be spent on essential goods like groceries or medicine, completely wiping out certain types of fraud.
Section 6. Risks to commercial banking. Now, we've seen the incredible perks, but let's put on our central banker hats for a second. This direct connection introduces some profound systemic risks to our banking liquidity. If we, as the central bank, roll out a retail CBDC that is just too safe and too easy to use, well, citizens might yank their money out of their local commercial banks and park it directly with us. And that threatens to totally gut the very commercial banks that anchor our entire credit system. The disintermediation risk here is real. If households start swapping traditional bank deposits for CBDCs in droves, commercial banks actively lose their vital funding base. They absolutely need those everyday retail deposits to maintain liquidity and to issue loans to local businesses or someone trying to buy a house. If that base vanishes, commercial lending could just freeze up. To prevent a massive credit freeze, we at the central bank would have to step in. This is known as the neutrality proposition. We would essentially be forced to recycle all that lost liquidity straight back into the commercial banking sector. We'd have to constantly lend reserves back to these banks at subsidized rates just to keep them afloat, which means the central bank is suddenly taking on a vastly expanded role in the whole economy.
So as we wrap up this explainer, we are left with a pretty tough question. The potential for absolute financial inclusion and seamless emergency subsidies is incredible, for sure. But is the perfect security of sovereign digital money worth fundamentally unraveling the commercial banking architecture we all rely on today? That's the delicate balancing act that is going to define the next decade of global finance. Thank you so much for joining me.